Hi, I'm Owen from Rask Australia. Thanks for tuning in to the Rask Network. Before we get into today's show, there are a few things we have to go over. Firstly, what you're about to hear and see is limited to general information only. It's not personal financial advice like you'd get from a financial planner. Also, it's important to remember that past performance is not indicative of future performance. That means that anything that's happened in the past, or we say today, is not necessarily going to reflect what happens in the future. Lastly, please consider that any of the guests or myself are featuring on this program may have a financial interest in some of the products or shares mentioned. That's enough from me. I hope you enjoyed today's program. Peter, thanks for taking some time to join me on the show, mate.
No problem at all, Owen. Thanks very much for having me.
Yeah, no, it's great to finally chat. I've seen you on Twitter, microcap Jesus, Saintly96. Is that what it is?
That's right. Yeah, it's Saintly96, and the handle is microcap Jesus. Yes.
Yeah, so I'll provide links in the show notes to that. If you're looking for a bit of fun, you can follow Peter on Twitter, talking about microcaps, shares his updates from the fund as well. So plenty to keep you amused. And mate, today we're going to talk about basically your journey to investing, coming from a legal background. We're going to talk about some interesting stories from that part of your life, but also now. One of the things that I thought was really interesting, which you told me on the phone last week, was that basically you managed to rack up a huge, turnover tab at CommSec, north of $40 million, while also keeping your balance below a few $100,000, I think. So maybe you can just kind of tell us a little bit about that year of trading for you, where you were at, what you were doing to rack up such a huge brokerage bill, I imagine, at CommSec.
Sure, and I suppose we'll start with this. You'll see the context in the bigger journey, but there were a number of years from the around 2011 through to 2015 where I was turning over a lot on CommSec. As you say, in 2015 or so, it reached around a bit over 42 million if you add up all the buy and sell orders. But yes, based on very little capital that I was working with. There's a couple of reasons for that. At that stage, I was still working full time, and obviously the two of those things don't meld all that well. And from 2016 on, I became a full time investor. But the years leading up to becoming a full time investor were essentially around proving to my wife, who was had quite reasonable concerns about the viability of this as a full time career, that I could do it profitably. My particular style of investing at that stage was constrained by fairly small amount of capital, so that I was really needing to get in and out of my best ideas. I wasn't really able to be all that patient and hang around and let things develop. But also my style of investing, which is not technical at all, it's based around predominantly at that time analysing ASX announcements and then trying to take that information, understand that information, and react to it faster than other people. Was one where I was, good at it, but it's not a perfect science, of course. It was one where I might get 6 or 7 out of 10 correct. And so the best way to take the luck out of the equation was to increase, I suppose, like playing blackjack at the casino. If you somehow have an edge or counting cards, is to take the luck out. You need to turn over as much as you can, and that's why I was doing that. It was so it sounds outrageous, that sort of turnover, but the reality was my average order was around 10 to 12,000. As you've mentioned, I was not leaving more than a couple of 100,000 at risk overnight at any one time. And so that's a sort of stage in my investing career that's changed a lot now, but it was the way to prove to my wife that I could do this profitably on a consistent basis. Whereas if you sort of leave money on a more long-term basis, you're going to have more volatility in terms of your month-to-month results, which didn't really suit what I was trying to achieve at the time.
So you sent me a screenshot of your CommSec account.
Sure.
I know you're pretty transparent with all of your investors.
Yeah.
And $66,000 was what you spent on brokerage, which is a fair wad of cash. Do you look back on that now and think that's a lot to spend on brokerage, or did it, like, because you made a profit, right? I guess it's all part of the course.
Sure. I mean, in that particular period I showed you, I made a profit of about $230,000. So I didn't even think about the brokerage from this perspective. I was really looking to make profits on a, if not day to day, then a week to week basis. So that I only thought in terms of post brokerage profits and loss. These days, if I did it, I would have looked for a cheaper brokerage option. And there were some around then, but none that sort of melded with my other Commonwealth Bank accounts and whatnot. Certainly these days I could have done it a lot cheaper than that and saved a bit of money. But in those days, it just was part of the cost of doing that particular style.
Can you just correct me if I missed this? Was this while you were working as a lawyer?
It was, yeah. So
how did you fit that in the day? Because from my understanding, you were trading, like you would react to small or microcap news. Like that was one of the strategies that you used because you understood businesses, like a couple hundred businesses that you followed pretty closely, and you thought you could react quicker than the market.
That's right. And so the vast majority of that reacting was reacting at the opening and of the day's trade. I got around it basically by doing a lot of work before the market and after the market at night, outside of normal working hours, and then during the day, doing normal work, but making sure that I glanced at the ASX announcements platform every 20 minutes or so, which is, I'm not suggesting it's ideal by any means. And things ultimately came to a head there. I had to choose one or the other, but there was a period for a while where I was able to do that just by being younger than I am now, having more energy and doing my day job, I suppose, outside normal hours.
So you did this to convince your other half that you could, take this on full time.
Yeah.
Yeah. Can we just go back and unwind this clock a little bit to how you got started, why you got started in law, and in particular criminal law? Like, can you take us through that part of your life? And I think there's some fascinating stories here that you could share with us.
Yeah, absolutely. Going right back, I studied law here in Queensland. I'm living in Brisbane now, and I did well at school and studied law at the University of Queensland. I did economics as well at the University of Queensland and did well at statistics and things like that. But I certainly had no interest in investing in those days. Just while I'm talking about uni, I suppose an example of how my mind works is that I gravitate to things that I'm particularly interested in, and I will work incredibly hard and be, to the point of obsession with things that I love doing. Whereas I find it probably difficult to get into things that I don't. That's not a particularly unusual trait, I suppose. But an example of that at university is that I had a real like of statistics and did very well at it, but then spent a good couple of years, instead of probably going to lectures and tutorials I should have been doing, I spent a couple of years trying to design the perfect system for predicting horse race wins here in Queensland. So in those days, this is only late 90s, very late 1990s. There just wasn't the access to data. And so what I was trying to do was create a regression analysis whereby you would put in up to, say, 20 different factors relating to a horse, its weight, its previous results, what barrier it was in, etc. About 20 different factors, and using regression analysis, try to come up with a model that would, pump out the odds of future races. In those days, the only way to access the raw data was to go to the university library and using microfiche, which was literally the film that you could that they used to save old newspapers on, trawl through those and photocopy the race results from the previous 10 years and then manually enter them into my system. So that's the type of thing that I would do instead of going to lectures. But it's an example, I suppose, of the fact that when I'm onto an idea or I want to research something, or I'll take it to the nth degree. But in any event, that worked okay, but it wasn't certainly enough to make me a great deal of money. And I finished law, got a job at a firm in Brisbane called Gill, Shannon and Luton, who were the largest firm that did criminal law. They did a number of different areas of law, but they were noted as being the sort of go-to firm for criminal law. They only did private clients, not legal aid, and so they got quite high-profile clients. They also did all the work for the police union, meaning that when a police officer got in trouble or a police officer was under investigation, a lawyer from that firm would often be assigned to that officer to help them through that process. And so that was particularly interesting. I did my second year of training in criminal law, and then after I qualified as a lawyer, I did 3 more years working for them in criminal law, and that included, as I say, with the police side of things, being one of the more junior members of staff. I'd be the one who would be sent out when there was a police shooting or a police car chase that ended in a death, for instance. There was always a need to have a lawyer on the scene to make sure that the police officers involved had their rights protected. So, that involved things like being called at 4 a.m. on Christmas morning to go out to the scene of a person who had stabbed a number of people and the police had shot him. And so spending all of Christmas Day dealing with the officers and going through their disciplinary interviews and whatnot. So, I mean, and at that age, in your early 20s, that's all very exciting when you don't have kids. But that's how I found myself getting into criminal law.
Yeah, right.
And disciplinary law, I suppose, as well. I mean, obviously, the stuff with the police isn't pure criminal law.
I know from a few stories that you've said you worked on some pretty high profile cases, right? Counsel assisting, and you did a lot of interview work and some of the higher profile cases in Queensland in particular, which you did email me about, and they actually did. I vividly remember them making headlines down here. And I mean, are there any stories or any kind of allegories between that time and what you do in the legal profession and what you do as an investor?
Yeah, sure. I mean, in terms of the journey from there, which I'll just cover first, I went to the UK and lived in London for 3 years, and I did some prosecution work over there in London, and then came back to Queensland, where I was counsel assisting the state coroner for 7 years, which was, by its nature, a position that involved extremely high profile sort of work. I've always sort of said that I approach my investigation, or I suppose study into a new company that I come across in the same way that I might have approached a new case that I came at as a lawyer. When I was working as the counsel assisting for the state coroner, I would get a police brief that would outline all the details of a particular death. And it was my job to go into minute detail to make sure that the police had covered off everything, to commence my own investigations into areas that I thought needed to be added to, either with the police help or on my own. And then we would, in some cases, take those, in many cases, take those cases to court, and I would present the case, the witnesses in front of the state coroner. And so that's essentially the way I sort of approach when I'm looking at a new case. It's an issue of looking at what are the facts, who are the people involved, which is still a massive part of my investing approach these days. Looking at the quality and the type of people who are involved in a company, and so that was the biggest parallel, I suppose, with my work at the coroner.
Can you lend any, I guess, even if not examples, just some techniques that you would use or strategies that you would use to, when you were interviewing people, to determine if they were of good character or if they were lying, just anything that you would kind of use, even if it's just heuristics, that maybe investors can use if they hear from management or speak to management.
Sure. I've thought about this quite a bit. I've seen recently on Twitter some people who I respect debating this issue as to whether you can really get much out of watching people or listening to people at AGMs, for instance, or whether you should be completely focused on the facts and what's written. There seemed to be a general view that there wasn't much you could get out of them, and that may be right. It's very hard to make a judgment on individuals solely on the basis of how they present or what they say. You definitely need to do it in combination with what they do and the actual facts surrounding either a death or a company, as it were. But certainly when I was, I probably did over 100 different inquests in my 7 years there, and crunching some numbers, I think I probably interviewed or examined as counsel assisting maybe close to 1,000 witnesses over that time. Look, the big things that you would look for are people that are who are obviously inconsistent or exaggerating things. That's one of the biggest things. People who, and this is my biggest things, wouldn't make concessions where it was pointed out to them that they'd made a mistake or that something just couldn't have happened, and they would doggedly insist that they were right, notwithstanding even the most damning evidence in some cases. So, you're looking for, and that's a sign of either dishonesty or arrogance in the case of witnesses. And so they're the similar things that I'm looking for when I ask questions of people at AGMs, and it's one of my things as an investor to go to as many AGMs as I can. And you're looking for directors or CEOs who are exaggerating, who are not or unwilling to focus on key things like actual numbers, as opposed to grand ideas and grand schemes and metrics that aren't particularly central to the company, who are unwilling to engage in discussion around actual profit, for instance, which is a pretty key thing for me.
Can you give an example of what might be a concession, either when you were investigating people or interviewing people, or versus, say, even in investing? Either one, I think, would just illustrate this point.
Yeah, a big thing is, just even with people who you aren't testing to see whether they're particularly honest or dishonest, people who aren't central to a case, an eyewitness to a traffic accident as a very basic thing. There's copious evidence that shows that eyewitnesses to traffic accidents or any incident are notoriously unreliable. And so you're often be asking people, in some cases you knew they were wrong because you had other evidence, whether it be camera evidence or a huge amount of other eyewitness evidence that showed that they were wrong. And so you would give them the opportunity to say, well, this is your evidence, this is what's in your statement, but could it have been the case that you were mistaken on this? Could it have been? Is there at least a possibility? So people that weren't willing to at least accept, the possibility of something. I mean, if people definitely saw something, and I'm not saying people have to always be vague, sometimes people have definitely seen something and they're right. But I'm talking about situations where, they couldn't possibly have all the information they purport to have. And so if they won't acknowledge that there's a possibility that this could have happened or that could have happened, where they, clearly may not have seen that or weren't in a position to see it or hear it, and they won't make that concession that there's a possibility that they're wrong, that's a red flag. It's a sign that the person's either arrogant or is more concerned with their reputation or how they appear, or not being embarrassed rather than actually being accurate about something. And that's, there's different motivations for companies and for CEOs, but it's again a case where CEOs may not want to be embarrassed, may not want to concede that they made a mistake. It's a very inexact science, though, because I'm the first to acknowledge that there's, some of the best CEOs, some of the best businessmen out there are people that are very arrogant and may not make those concessions. So it's hardly a science, as essentially an art to it, and it's only one of many factors that you throw into the mix.
And that's true. Yeah, I was going to say that comes back to what you said about being prepared for the conversation and understanding the facts. I think a lot of investors do tune into AGMs or maybe even ask questions of management without actually understanding the business and the various players inside that business.
Yeah, I think that's exactly right. And I try to make it a big thing that I understand the business very well before going to one of my biggest frustrations is going to AGMs where you have people asking, idiotic questions or questions that, yeah. I mean, I have a very low tolerance, sadly, for that. I also had a very low tolerance for, and this will come up later in one of the companies we discuss, for bad lawyers. There's a lot of bad lawyers out there, and especially lawyers who are not good at advocacy, and I should perhaps be more forgiving of that. But that's something that really gets me worked up.
I know from our recent chat that you also tend to follow other people, so not just management and in discussions, but you also tend to follow people like on social media or elsewhere, and you tend to kind of track them through time. Why is that important to you?
You're talking in relation to people associated with companies, or more with,
or even just promoters and spivs and that sort of stuff.
Yeah, that's true. I mean, that's something that has been an eye-opening thing for me. I think if we go back to a sort of transition from the law into this area, or into finance generally, and I'll come back shortly to back to my development. But I was incredibly green in terms for most of my time as a lawyer in terms of how the world of finance worked and whatnot. But it was an eye-opener as to how many people in finance, even in listed companies and whatnot, behaved particularly poorly. The level of just outright fraud that there sometimes is in listed companies. And people like John Hempton and others who actively track this stuff and track individuals far better to speak to about this sort of stuff than I am, and then they do it on an international basis. But certainly, it's something through social media and through just a general involvement in small listed companies for the last decade that I keep a close eye on and make a big thing not to get involved with those people in future. I mean, for a long time in my after I started my fund, 300 Capital in 2016, there was a long period where I would look back at the best results that we'd had, and the top company was a company called Big Unlimited, which you would be familiar with. I mean, and that's embarrassing for me. I invested in that at an early stage, at around 20 cents and probably sold out around 50 cents and did very well out of it. It ended up going to $5 before, it was discovered to be just an outright fraud. And so that's the type of, or the level, I suppose, of spiviness of in that case, whether it's been proven to be criminality yet, I'm not sure, so I should be careful. But yeah, that's the stuff I'm on the outlook for. I mean, that was an interesting case in that I think it differed from others in that there was, it made it very difficult because of the specifics around what they were doing to identify as something that was a bit off. In that case, normally you're able to look at red flags where there's a lack of cash flow following what's claimed. In that case, of course, that there were mechanisms that allowed them to show the quarterly cash flows as being spectacular. But yeah, there's other examples, and it's difficult. Because I don't want to name some of the people that are involved. I also, am the first to acknowledge that some of those people, and it touches on what I said before, who appear to me to be promoters or spivvy or a bit dodgy in some way, are people that have, ultimately done very well. And this particular market, I think, has rewarded some of them. So my style of investing, which is very much focused on companies that are probably a little bit boring, on management who are non-promotional, and on companies that are running businesses that are generally profitable, and so away from that world has not really been a particularly sexy and interesting area to be in the last few years. But yes.
So you've kind of touched on why you went into investing when you talked about like it being a hobby for you, and then a passion, and then convincing your wife that you can do this effectively. You started with 300 capital, which then later turned into West Ferry. More recently, actually turned into West Ferry.
Yeah.
Did your investment process change in that time, like from the time of you starting 300 capital to now, or to West Ferry? Like, how can you describe that period and how you went about investing? Because the fund grew pretty quick. You had friends in there, and then you kind of had to get the AFSL and go from there.
Yeah, that's right. So after the that period of really intense investing, my wife was sufficiently convinced that I could do it on a full-time basis, and I decided to do that. And my original intention was only to run my own money, and to basically scale up that process of what I've been doing, and to the extent that I had a bit more capital, or could get a bit more capital, to try to be a little bit more patient. When I did that, I had friends though who wanted me to manage the money for them. I started a private company structure, and a number of friends gave me money to manage, and we started off with only about $500,000 in late 2016. The company was called 300 Capital, and the great benefit of that for me was that it allowed me to be more patient. So I was still at that stage, engaging in my model of fairly high frequency trading, but again, nothing to do with technicals. My modus operandi was to have a really good understanding of several hundred companies that I built up over many years, simply from a bulldozer approach of reading day in, day out ASX announcements, obviously only scanning the titles, but then opening and reading the full announcements of those companies that seemed interesting. And then, as many of your listeners will know, that in the course of a trading day or pre-open, companies will put in an announcement that relates to a significant change. If it happens during the trading day, they were the most beneficial to me, because they were situations where the ASX halts trading the company only for about 10 minutes or so, and then it resumes. Now, if BHP or Commonwealth Bank puts out an announcement during the day that's market sensitive, there's thousands of eyes on that announcement, and in that 10 minutes, thousands of extremely intelligent people will take that information into account and come up with a pretty good assessment of what it means and how the price should adjust accordingly. Now, with companies that have a market cap of sub 200 million, say, there's just not the same number of eyes, and sometimes there's no eyes on those announcements during the day. And so every now and then, I would find that I was able to either much more quickly or through luck be the only person who seems to have seen the announcement, react to those much quicker than others and take advantage of either buying or selling accordingly. Yeah.
So this went on for a few years, right? So how, now that you've got like the AFSL and it's a wholesale AFSL, you can bring investors into the fund. How has your investment process changed? Like, would you say that your investment philosophy has changed? Like the way you think about investing has changed along the way too, as well as the process?
Yeah, it absolutely has. Some through necessity as I grew, the ability that those opportunities I spoke of, you can only allocate so much capital to those, and it's often a case of getting it in and getting out fairly quickly. And so as I've grown, so we've gone from that $500,000 in late 2016 through to currently we have under our new AFSL license entity, West Ferry, we've got a bit over 18 million in funds under management now. And so there's just not the same advantage to be made, or it doesn't have the same effect, I suppose, on the overall returns of the fund, given its size. But one of the main reasons I decided to take on money in any event from outside was to allow me to have more patient capital. So in those early days, for instance, I was identifying really good companies like Jumbo Interactive. I was investing in it at 40 cents and, selling out at $1.50, thinking I'd done really well. And it's obviously a company that's went to the high teens some time after. Companies like Appen, I was investing in at 60 cents and selling at $1 something. Again, taking quick profits because I needed to move on to the next good idea. And I wasn't convinced that at that stage that there was an immediate upside, even though I knew that there was probably good medium-term prospects. So having the further amount of capital allowed me to take more patient positions, and over time, over the subsequent years, I've essentially transitioned more and more to the latter, being more positions where I am holding for much longer periods. And so that is a different style. I mean, I still can't resist the a trade here and there where there's a clear piece of information that I think I can assess better than others. But yeah, certainly these days, the majority of my profits in the last couple of years, the vast majority have come from our largest holdings, which have been holdings in companies that I want to hold for many years, because I think they're really good companies.
One of the questions that I got coming into this to ask you was basically, how do you find new ideas? Because when you look across your portfolio, you seem to have ideas from different industries, different types of businesses altogether. You told me that they tend to be founder or like strongly aligned, kind of like owner operator style businesses, and they're typically microcaps or small caps. But how do you find those ideas as kind of an individual investor looking at these things?
The main way is through that bulldozer approach I told you about before, just literally scanning the ASX announcements platform each and every day, which obviously helps when you can do it full time. And when there's a market sensitive announcement from a company I don't really know or can't remember hearing about before, I'll read that. And then that will take me down to a path sometimes of researching that particular company. And so I build up a knowledge over many years by doing that. One of the best ways to find new companies, I find, is particularly around the 4C season, as it were. So 4 times a year, the companies that haven't satisfied the ASX that they are sustainably profitable have to put out a quarterly cash flow report. And that's the best way I find, is to find a company that is going from that early stage of being unprofitable to perhaps just getting to the point of profitability. And it's the best way to find that company before it reaches the radar of other funds or bigger investors. So and that's full of tricks because, you know, a quarterly cash flow is obviously different to profit. Cash flow can be affected by many things, including working capital changes that mean that it doesn't necessarily reflect profits. You have to really reflect on whether what you're seeing is an aberration, just a good quarterly cash flow that has been affected by a one-off factor, or whether it's something that actually does indicate, hang on, this is a company that's been a bit of a dog, or you know, has really, I think, is one where the market hasn't been satisfied that it would ever reach profitability. They've had a great quarter. Hang on, is this a company that's actually making that step change or reaching an inflection point, or something that is then going to make it? And then that becomes an art form in itself, because even if it's not, you think, well, hang on, even if I realise that it's a one-off, or it's not quite what it seems, I know the market's going to love this in any event. And so is there a trading opportunity there? But that's one of the big areas. Otherwise, it's, you know, I have used stock screeners, particularly as a hobby. I like to look for sort of overseas stocks, even though I don't invest in them at the moment outside of New Zealand. And so that's a good way to do that. I just find that they're so unreliable, even the really good quality ones, when you're talking about small and medium-sized stocks, because they really don't factor in the one-offs or the underlying profits in small and micro-cap companies. And so it's very hard to get reliable feeds from them.
There's one company, I think is it Pacific Turbines Brisbane? Is that the company? Yeah.
Yes.
I thought this is an interesting example, because I guess one of the things that you would have had to have done when you're investigating people is you'd have to be incredibly thorough, right? You'd have to understand every detail. But we tend to see that accountants often turn to investing because they're numbers focused and they understand accounts, right? So they go over them and they kind of really get in the weeds on that sort of stuff. But you had that from a qualitative aspect as well, insofar as judging kind of the bigger picture, like how does this thing come together? Maybe that serves as a good example, Pacific Turbines Brisbane, as it's a good example of illustrating how you approach things and the level of detail you go to.
Yeah, it's our biggest holding, Pacific Turbine Brisbane. It's a bit better known now, but I've used to trade in it back in 2013, 2014, when it was a much smaller company. So I've been aware of it for a long time, but it's been our largest holding now for a couple of years. So it's got the code PTB. It's got a current market cap of around 130 million, but I've sort of been involved in it when it had a market cap of around 30 million. So if you go right back with PTB, it was actually listed on the NSX many years ago. And then around the time of the GFC in 2008, there was a bundling together of a bunch of aviation businesses, a small regional airline, a big leasing business, and an MRO, which is a maintenance, repair and overhaul facility here in Brisbane. And they were bundled up together. They got a big loan from NAB, I think at the time, which was to finance all these different aircrafts that they would then lease out. They listed on the ASX, and literally within a month or so, the GFC, the worst part of the GFC hit. Airline leasing became the least cool thing in the world. NAB pulled funding on them, and literally, as the story is told, NAB just rang up and just said that the facility is no longer available, which caused and that's not having a go at NAB. That's what all the banks were doing at that stage. There was genuine panic, and it meant for PTB that they had to enter into a fire sale of certain aircraft that they'd purchased. They ended up with huge losses as a result. They sold off a lot of stuff. They sold off the small regional airline. They sold off a lot of aircraft, and they were left with a shell of what they'd originally listed with and a very large debt. And so the journey over the next few years is to try to then run the MRO, the workshop that dealt with overhauling and repairing engines, which was a really good business, profitable business, but quite small compared to the debts the company had. And that's what happened for the next 3 or 4 or 5 years. It was just a case of running the business that they had and paying down debt. There was no real prospects of them being able to do much else. It's only from around 2016 or so that they finally got to a point where the balance sheet was strong enough, and it became quite an interesting company. So their core business is a workshop in Brisbane here that overhauls what's called the PT6A engine. It's a prop turbine engine, which is the most widely used aircraft engine in the world. It's been around since the 60s, made by Pratt & Whitney. And it's mainly on aircraft that are big enough to hold, say, 20 people if it was a passenger aircraft. But think of planes like the Flying Doctor's planes, or slightly bigger planes than that. A lot of crop dusters, for instance, will use that engine. A lot of small freight planes. There's a whole fleet of small planes, the Cessna Caravan in the US that freight companies use, and seaplanes as well. So they're very big use in seaplanes. And so that business continued to do quite well. It's had issues in that it's, if you look at it from an outside perspective, it's got quite low return on capital, because it's a company that needs to hold a very large amount of inventory. You need to have essentially an inventory that covers all the parts of these engines so that you can act quickly on them. And so that wasn't a particularly exciting part of the business. But what it did have is a management and a board who are heavily invested themselves, who had been successful in the past by building up a helicopter repair engine in New Zealand and then selling it off to the Chinese. And we're looking to do similar things again. So I was already invested in it in early 2020, January, February. They raised capital at 69 cents a share in order to buy a US business called Prime Turbine. It was an incredibly sought after raising that Morgans did here in Brisbane. It was, I remember at that stage being very keen on it, and I think I was scaled back to only 10% of what I asked for. I tried to sub underwrite it and got barely allocated anything. And so it was raising at 69 cents. The stock traded in the, well into the 90s in the period around the raising. And the whole idea was that they were going to buy this US operation, which was another MRO, and they were going to roll out their very successful way of operating their Brisbane MRO, which is far more efficient than a lot of their competitors. So, as I say, in February of 2020, you couldn't get this stuff at 69 cents. In late March, April, of course, COVID had hit. So only 6 weeks later, aviation businesses were incredibly unpopular. And PTB was thrown in the bin with all the other aviation businesses. And those 69 cent stocks, shares that you just couldn't get your hands on, were trading in the low 30s by late March, April, and just being relentlessly sold. And this has probably been my best success of the last couple of years, is that I was aware, probably more than others at that stage, of exactly the type of planes that this company dealt with. So they had no exposure to wide body planes, no exposure to the type of planes that were universally grounded at that time. The vast majority of the planes that they serviced were still flying. And to the horror of my wife, I would sit here possibly because I was losing so much money in all of my other companies, but I would sit here looking at the flight tracking websites and track the movements of the planes that these type of engines were attached to, in order to satisfy myself that I was right, that in fact crop dusters and cargo planes and flying doctors planes and seaplanes that had to still carry crucial equipment and whatnot between islands in the Pacific were all still flying, and that yes, they were going to take a hit because one of their biggest clients was a tourism-based operator in the Maldives, and obviously they were going to be hit badly. But the vast majority of their clients were not going to be hit that badly. Everything out of the company was saying, well, we'll take a hit in some areas, but we're generally going okay. And so that's really how it became our largest holding. That I kept buying very hard into that period in sort of April to June in 2020, when it was being thrown out by other funds. And so there were, in terms of your question about how much detail I would go into, part of it was that study of the type of planes and tracking actual down to individual flights. I also knew that their balance sheet was far stronger than many people realised. So that they were carrying a fair bit of debt, which on the face of it may have looked concerning, but when you look at it, it was offset by incredibly strong assets. A lot of the debt was firstly non-recourse, so it was only recourse to particular assets that were, whether they be planes or engines, that ultimately were not going to affect or cause detriment to the survivability of the company. Secondly, the company had two properties, one in Sydney and one in Brisbane here, that they owned and were on the books at cost. And so I visited the property in Sydney at Warrawood, and I knew the one here in Brisbane at Pinkenbar. Essentially did my own valuations based on, having done lots of years of being involved in REITs. And it was clear that they were worth way more than what they were on the books for. And the other thing is the actual inventory for a company like that is, it's we're not talking about the inventory of a retailer, for instance. These are plane parts that have essentially been around since the 60s and will be around and useful for another 50 years. They can be easily repaired and sold on. And they hold their value extremely well. And as is proven since, they again are very conservatively valued, so that often when they are sold on, they are sold on at a higher price. So there's other little things. There was a $2 million or $1.5 million of assets. There was a loan to the CEO for his shares, which was obviously a very sort of secure type of asset. And that also gave me some confidence, I suppose, that the company was in far better shape than many people realised. So that's where we've gone with that company.
Yeah, it's pretty obvious to our listeners how much you go in depth with these companies. And also, I think if you look at your portfolio, the kind of the breadth of companies in terms of how different they are illustrates kind of your go anywhere approach, but also your conviction in your ideas, which has to be born out of research, right? So there's another company in there that I know you've spoken about once before, but I just thought it was interesting because a lot of our listeners may be old enough to remember the kind of debacle with Slater and Gordon and Shine Lawyers, not to a lesser extent, but mainly Slater and Gordon, which is basically the business became a multinational business very quickly and ended up with this huge work in progress or WIP line item in their accounts, which was basically a non-cash item that represented work outstanding by the lawyers. And that ultimately was a massive thing that brought them undone. And I guess empire building was another thing. And so when people see legal businesses they tend to kind of cringe a bit about the idea of investing in such a business. And I think there's a kind of line of thought that suggests that when people invest in, professional type services businesses, a lot of the surplus or value that's accrued goes to the employees rather than to the business itself. But I know that you have Australian Family Lawyers, or AFL as the ticker code, in your top holdings, or at least it has been consistently over the recent months. So I'm just hoping maybe you can break down that business for us and why that would be different to, say, a Slater and Gordon.
Sure. And I have reason to be more skeptical than most, I suppose, because if I look back on all of my investments, and I keep pretty meticulous records, I think Slater and Gordon's probably my worst ever result. That was that's an example of a company that's probably reflects my growth as an investor. So that was one where, the Slater and Gordon's Australian business is fine. It's a fine business. It's not great. But it's good. It's a good business. I think management have paid far too much, but it's an okay business. What they did is, as you've touched on, bought a UK company, paid an enormous amount of money for it. From memory, it was many hundreds of millions of dollars, and I wasn't particularly interested in that at that stage. It seemed to me they were paying a fair bit of money for it, and I wasn't particularly interested. But afterwards, there was hints that company was having some problems. The price fell quite sharply of Slater and Gordon, and that's what piqued my interest. And I started to invest on it as a value play, I suppose. It was what was in my mind, that there'd been a market overreaction to these rumours of the UK company, and so I was satisfied by the adamant position of Slater and Gordon, as put out in a number of announcements, that they had taken a team of lawyers to the UK, had sat down and gone through every single file of this UK company that they were purchasing, and had satisfied themselves that it was fine, and that there was no fraud, and that these rumours were misconstrued. And so I continued to buy it as the price fell on the back of that assurance. And as we now know that that wasn't the case. I have no idea what the lawyers over there were doing. A bunch of lawyers on a trip to the UK might have been getting up to all sorts of stuff. There's lots of fun to be had, but certainly if they had gone through every file, they clearly missed a lot, because the company essentially was, if not a fraud, then a complete dud. Just about all of the asset was written off not that long after, and it's still the subject of of several legal claims, both against the company itself and against their lawyers and against their accountants. So I take some solace from the fact that that there's at least and some of those are settled, so the actual acts, the negligence has been established, or essentially established in those cases. So yes, that's one example of why there's been a horror show in relation to legal services companies. The other one is with Slater to an extent, but more so with Shine Lawyers. Shine Lawyers was actually a very successful listing. I was part of the IPO on that. It's it's got a strong brand, particularly here in Queensland, and it did very well in its early days. But I actually have an email floating around somewhere from when it listed saying that I got in and got out quite early on that stock, because I actually have an email saying to someone that this is going to be, this is going to blow up one day, because as a lawyer, I was very familiar with the concept of WIP, work in progress, where as a junior lawyer, you essentially beaten over the head by senior lawyers to ensure that you record all your time, no matter how useful you might think it is as a junior lawyer, and that it's ultimately up to the senior lawyer or the partner to write that off at the time of billing if they think it needs to be written off. And the reality was that come time to bill the client, a lot of the stuff on the bill that had actually been recorded is just rubbish. It's stuff that you couldn't possibly honestly charge a client. That was my personal experience anyway. And so I had great concerns that this massive build-up of WIP on the books of with Shine would actually be something that is, certainly 100% able to be collected one day. And that seemed to be the view of the market. The market and all the analyst reports were assuming that WIP was real money, that it was something that could be or collected at some point. Now, Shine, the price crashed at one point when it became clear that they were having to write down massive amounts of that WIP, and that completely changed people's views of it. So, and that's given it's given the whole industry a bad reputation, and completely and probably understandably put off many investors. My position is that Shine and Slater's now are both, perfectly adequate businesses. I'm not invested in either, and I don't think I ever would be, because I think they're both far too expensive. I don't think they're great businesses, but they're fine if you value them on the cash that they're bringing in. Again, I think in Shine's case, people are starting to value it on the accounting profit rather than the cash profit, which is why I think it's far too expensive. If you value it as a on its cash, there's nothing wrong with it. Now, Australian family law, A, holds many advantages over those companies, and B, is very different in terms of how it accounts for its profits. So, one of the first things to differentiate Australian family law from those companies is that there really isn't a build-up of WIP. So with a family law case, generally clients come in the door, they usually pay up front for an initial consultation. And then if they're taken on as a client, they're usually sent a bill every 2 to 4 weeks. Often the money is actually having to be put up front in the lawyer's trust account. The bills are sent and immediately deducted. So there's a very close connection between cash flow and actual revenue. There's not this build up, and so you don't have that potential future disaster like you have in the case of especially Shine. The other advantage that they have is that family law is a genuinely national jurisdiction. So personal injury law is different in every state. It's not necessarily, it doesn't necessarily lend itself to a national type of company or a large listed company, whereas family law, you can have a lawyer in any state who will understand the jurisdiction and the law as it applies in any other state or territory. And therefore, there's much more prospect for the sharing of resources, the sharing of staff, especially in this age of being able to work remotely, and the sharing of things like precedent and the use of articles and research that can be used for promotion of and social media exposure and marketing in each of the other jurisdictions. And I think that's something that they're starting to make use of. Now, it's still, take all that aside, it still has this, AFL still has a large group of skeptics, and that's fine, simply because it is as they would say, a personal or professional services roll-up. The company itself will say, well, we're not a roll-up, we are buying large companies in Sydney or larger practices in Sydney and Melbourne because that's the speediest way to actually get to scale. But the majority of their growth has come from bringing on partners or senior lawyers from, I suppose you could say, poaching those lawyers from other significant practices and giving them more prospects than they have at those practices in terms of bonuses, profit share, and being able to build up their own practice. And so I think it's going to be a very long time before it gets over the skeptics who have been burnt by these sort of roll-ups before. But again, I'm a person that focuses on who are the people involved. And in this case, the managing director, Grant Dearlove, is someone who I know to be a very good lawyer in the past, but also, a particularly good manager and motivator of people. And that's what this company needs at this stage of its development. He's someone that can go to other senior lawyers. Lawyers can be quite eccentric at the best of times, but can corral them into a cohesive unit, in my view. And so it's essentially, backing him, backing the team that he's put together. And my longer term view is that if his sort of vision can be created where they get a genuinely national family law firm at scale, you're going to have a company that is quite attractive to larger funds, because once it does get to a scale and get some consistency in earnings, it's really going to be the only player in that space. Everything else in family law is a cottage industry, and it's a great industry to be in. It's an incredibly defensive industry that in my view, will ultimately attract much bigger investors if it is executed right.
Yeah, I've got to admit, like, humility is important in this game. I got caught up in Slater and Gordon, and I held Shine for a while. In fact, I made money from both of them, but I wasn't exactly proud of how those two ended. But this is a really interesting business. I was just looking at it now as you were speaking through it. One of the things that you brought up there was basically management, right? And how important that is to be motivated and
yeah.
Also, especially when you're attracting high performing people like lawyers, right? While we're on the topic of people, I asked you the other day about red flags and amber flags and green flags and some of the things that you use and some of the heuristics that you've developed over time around identifying companies. I'm hoping, because I think you've got a pretty interesting idea around a red flag and as it relates to management, but I'm hoping you can just share with us any kind of red flags that you've come across whilst kind of hunting through this micro cap / small cap part of the market.
I have. I mean, I sort of touched on it before in terms of the type of responses you might get from management in terms of how they answer questions. I mean, one of the big things is, those companies that seem to try to tie themselves in with the latest trend, whether it be, the one to look at the moment is anyone that talks about having a product that ties into the metaverse somehow. I think is an immediate red flag to me. Anyone that talked about having something that was AI a few months or a year or two ago. I mean, that's not to say that some of these aren't entirely legitimate, but there's a type of company that will suddenly find a way that its product ties into the zeitgeist, whether it be AI, the metaverse. There's been heaps of them, baby milk powder, cobalt, cannabis, whatever the latest trend is. That's something to be concerned about, and mostly those are companies that are not yet profitable, and so they're probably ones that are easy to avoid in any event for me in terms of what I'm following. But yeah, that's something that jumps out. I mean, the other thing for me is I suppose the opposite of a red flag, and you touched on, is looking for management and executives who are heavily invested in the company themselves. I'm really looking for management who are essentially running like a family business or a a small business where they know that they have a genuine ownership in it. And so I suppose the opposite is a red flag, where you have a CEO or management who are insistent that they have a great idea or a great product or a great company, but aren't investing in it themselves. Or and this is mostly a problem for larger companies, where you have a sort of a box ticking board who aren't invested and are really, in my view, sometimes there for the prestige of being able to say they're on a board. I mean, being on a board can be a very difficult and risky job as a company gets a lot bigger. And for some of them, that the focus is so much on ensuring that there's or that they're focused on risk avoidance rather than actual entrepreneurial aspects. So, they're sort of red flags that I also look for.
I think I don't know if you want to bring it up, but I think you had an interesting idea about, like, this comes back to that tying into that tracking people through time thing. A company on the ASX, I'm not sure if you wanted to go there, but it's up.
Yeah, sure.
I'll throw it up to you, which is Story Eye.
Yeah, and that's right. That's another company which has been interesting for me. So it's called Story Eye. The code's SRY. It's now suspended. So it's one that caught my eye again from just trawling announcements, and on its face, it has a great story to tell. Right? It's a company that operated and still does operate Apple reseller shops in Indonesia. Now, it's one of only 2 or 3 of the shops in Indonesia that are able to legitimately resell Apple products. Apple itself doesn't have any Apple stores in Indonesia, predominantly because the government there requires a certain level of local ownership of any business that operates in Indonesia. And Apple have basically just said, well, we're not interested in that. And so the only people selling genuine Apple products were, 2 or 3 companies. And Story Eye was a company that was going to snap up, I think was the plan, snap up one of the more junior partners, and it did ultimately get to a point where it was the second biggest of the resellers. And my whole theory was, it's selling Apple products is a difficult game because they're very powerful. The margin's low. We saw in Australia with, I think, Phone Zone tried to do it, and the margins are so low that it's difficult. But I thought in Indonesia you have the great advantage that an iPhone in Indonesia is sold at essentially the same price as an iPhone in Australia in terms of actual conversion, so the same Australian dollar value. So yes, there's a very small margin, gross margin, and in Australia that gross margin is almost impossible to sustain when you have to pay rent and staff. But the rent and staff in Indonesia are a fraction of what they are in Australia. And so my view was that, well, you're earning exactly the same gross margin in Australian dollar terms. You really should be able to eke out a pretty decent profit when you're only paying Indonesian levels of rent and utilities, and particularly staff. Now, in hindsight, there's a massive amount of red flags to this company. I mean, why is it listed in Australia? Well, they seem to explain that okay, in that they wanted to get some level of legitimacy. I mean, the other thing that gave me some confidence in them is the fact that, well, Apple are dealing with them, right? Apple are actually allowing them to sell their products. Apple are actually visiting the stores according to the company and ensuring that the stores are at a certain level. And so I ended up having a reasonable sort of investment in this company. Over time, I actually made a profit out of them, looking back at my records. But I had at one point an exposure that was probably far more than I would normally have or should have had. And that's the type of thing that lets you lie awake at night sometimes. And so it's one where I ended up doing a lot more delving. And over time, there's an Indonesian, so the management was based in Jakarta, an Australian board. And over time, my research of some of the people involved raised a few concerns. And I was increasingly asked to deal with a fellow who was not actually noted on the board or management, and he was Singapore based. And that was fine. He was very knowledgeable. He was a large investor in the company himself. He gave me all sorts of reasons as to why he wasn't actually on the board. My own research eventually, and it was difficult to find, but eventually I found that this guy in Singapore who I was dealing with had been in Australia for a long time, and in that time had twice been convicted criminally in relation to various things. One essentially involving the withholding of wages from students who were sort of consistently lied to by him. So that raised some major red flags. I kept doing significant research into social media, into all sorts of ways of trying to find out how these stores were going and what they were looking like. And eventually I said, look, I've got a lot of money exposed here. I'm actually going to just fly to Indonesia and go and see these stores myself. So I my wife wasn't overly thrilled by that, but I flew to the island of Java, where most of the stores were based, and went to 4 or 5 of the major cities in Java, and obviously finished in Jakarta, and went and visited each of these stores, and then also turned up at the head office in Jakarta and ended up having a meeting with the CEO and checking that out too. And so, look, this company is ultimately, as I say, ended up in suspension. It seemingly was a great idea. It was making reasonably good revenue, but could just never make a profit. My own research, when I got there on the ground, actually showed that these stores were magnificently presented, as you'd expect if Apple were checking on them. The head office appeared to be all legit. There was certainly a lot of people in there working and appearing to be busy. There's many reasons I've formulated as to how and why it didn't actually work. But I suppose that I raised that as an example of the extent to which I was prepared to research it. It probably didn't actually get me an answer in the end, but the number of red flags that I picked up meant that I did ultimately exit that and managed to get out with, as I say, a small profit on a company that subsequently, I think probably won't trade again.
Why did it get suspended?
They didn't. I was out of it by then, and it was too painful for me to read too much of it. But my understanding is that they weren't able to file their annual report for a long time. I mean, I had concerns about their reports. The accounts were appallingly presented, right? So, I mean, one example is that they, in one half, presented this cash flow of, they had an operational cash flow, suddenly a massively larger operational cash flow than they'd ever had before. And when you dug into it, it just made no sense whatsoever. And the best answer I actually ended up with from the company, and it seemed to be the case, is they'd actually borrowed 6 million Australian dollars from a bank, a Singapore-based bank, and had put through these borrowings through as operational cash flow, as opposed to debt. And it's not something that is ever questioned. There was, this is a company that had a market cap of around $6 or $7 million at one stage. There was hardly anyone of note looking at it. It was just a mess. And it's eventually, it seems that the ASX has caught up with that aspect of it, questioned the accounts. And it seems that the company haven't, I mean, I know that they've now filed their annual report, but there's certainly no sign that they're going to resume trading at any time. So my best answer to that is that it seems to be some concerns the ASX has around the accuracy of the accounts.
I think you've illustrated to us kind of like the Wild West that can be microcap investing, even on a regulated exchange, right?
Exactly, and yes, so that's the difficult part. I mean, and the frustrating part with Story Eye was, in the period after I had realised that this is a company with some major issues. Occasionally, they would put out an announcement that was seemingly quite exciting, and it would attract. And I'm pretty sure at one stage it became the subject of one of those now notorious Facebook or social media, pump groups, and the price would, I think at one stage went up 200% in a couple of days after I was already out, and so that's quite frustrating. That I miss the excitement there, but it's now gone back to zero, and I don't think it will trade again.
There is one question that I do like to ask all guests on the show before you leave, which is just that if you could go back and tell a younger Peter one thing about investing, what would it be? You've had quite a diverse background, and it's like things are moving really fast for you with West Ferry now.
Yeah.
So what would you tell yourself?
I thought about this. My motto would be, and what I tell myself is that anyone can play. And by that, I mean, I think I spent many years looking from the outside. I still remember being a fairly highly functioning person in my late 20s who just had no idea about finance or even things like superannuation or whatnot. And in my mind, I think that I always thought, well, the equity markets or being a fund manager, that's for other people. That there's obviously a certain path you have to follow to get there. You need to go and work for I didn't even know, but I expected that you would need to work for certain types of organizations and then build your way up so that you can eventually get to that point. Just while I'm discussing that, I remember just before I finished university, I think I was applying for all sorts of jobs. I remember applying for a job at Macquarie, and it was either a cadetship or an internship or something like that, but it involved like 3 stages of interviews, and I got through the first 2 fine. But I remember having an interview then with, the last interview was with a reasonably senior person there. And I remember them asking me what I wanted to do. And I just had no idea. I had no idea of what, I'd done my basic research that you would do on the internet about, what happens at Macquarie, but I couldn't have been more green. I had no understanding of what practically happened on a day-to-day basis at Macquarie. So when he started digging down into actually what I wanted to do on a practical basis, I just had no idea. And, he ended up answering the question for me, I think, saying, I suppose you want to, ultimately build up to a position where you're maybe running your own portfolio at some stage. And I said, sure, yeah. And I didn't get the job, understandably. I think the other problem was they wanted to know what financial press I read, and I think the best I could tell them was the business section of the Courier Mail, which was basically as good as reading a comic. But anyway, I suppose that my thing about anyone can play is that I've ultimately found a passage, because when I did get into finance and into the share market, I found that I had such a passion for it that I just ultimately found a way through the fact that I had no particular background in, working for an investment bank or working for, even an accountant or for any sort of financial organization, and have found a way applying other skills to it. I'm fortunate in the way that I probably found it later in life, because I had then friends that, had also done reasonably well for themselves and had money that they could give me to manage. That's, something that I suppose not everyone has, but, there's a million passages to get to a point where you can play a significant role in this industry. So don't be too concerned if you don't think you're on the right path. Things can change very quickly down the track, and you don't really know what that particular path's going to be.
I think that's wonderful advice. I think a lot of people are put off when they listen to podcasts like this and they see people in suits in the city or on TV.
Yeah.
They think it's such an overwhelming thing, and it's really not. If you commit yourself to learning and you kind of have that bulldozer analogy, which is really neat. I think that's really important too, is just kind of reading widely and just giving it a crack. I think great advice, mate. So
yeah. And the other thing is, I think the people that often are the most intimidating or look like they're most at place in the industry are, as you really dig down to it over time, are often, are often making it up as they go along to an extent as well. And so, yeah, don't be intimidated at all.
Wonderful advice, mate. I'll put links in the show notes to West Ferry, which is the fund. People can play along on Twitter. They can follow you. They can get your insights on the website too. So, mate, I know this is your first long form interview, so I really appreciate you taking the time out and joining me on the show.
No problem. Thank you very much, Owen.